Financial analysis made easy for assisted living. Senior managers of a community must be comfortable with their budgets and understand the financial principles affecting community operations. The average executive director or middle management supervisor with little and no training in accounting may find company financial statements confusing. However, if one studies their form and function and learns the meaning of a few accounting terms, these statements are not hard to understand and reveal a great deal about the community's financial health and the effects of individual departments' performance. In this module, we will learn about operational and capital budgeting, accounting methods, financial definitions, how to determine your facility's cash flow, calculate capitalization rates, revenue multiplier, debt service coverage, and other important financial ratios. You'll also learn how to negotiate with vendors and evaluate service contracts, and additionally some tips for expense reductions and incentive plans are also offered. When I first got into this business, I was intimidated by owners and analysts who talked capitalization rates and revenue multipliers and financial ratios. But what I learned is that's the only thing they know, and it's easy to learn what they know. The hard part of operating these communities is the day-to-day interacting with people and staff and balancing everything together. In this course, I hope to be able to teach you to learn how to speak the language of your owners and analysts so that you can inspire confidence in them that you understand the big picture, not just the day-to-day operations. Let's talk about why it's important. The successful operation of an assisted living community largely depends on the executive director's ability to balance the financial objectives of ownership with the interests of the residents and the employees who serve them. If one interest is put before another, then it doesn't achieve a balance. So balancing these conflicting interests and achieving resident satisfaction while maximizing return on investment and adding value to the project are really the trademarks of a seasoned executive director. Let's now explore the different types of facilities, each of which are going to have different types of financial objectives. First, proprietary, then nonprofit tax exempt, then nonprofit taxable. Projects with proprietary ownership are commonly referred to as for-profit communities. Generally, they're sponsored by a privately owned corporation or a publicly traded entity. In publicly owned companies, equity is usually divided into common and preferred stock, held as retained earnings, or distributed to stockholders' equity accounts. Profit may be distributed as dividends. Private companies are generally capitalized, which means the investors all kick in money, by a group of investors or through private funds who are under no obligation to disclose financial results except to their investors. The owner or partners each have an equity account to which profits are distributed. They expect a return on their invested dollars, much as one would expect interest to be earned on money in the bank, the fundamental difference being the rate of return and the corresponding risk of the investment. The primary operational advantage of proprietary ownership is the owner's degree of control of the real estate and the operations. Proprietary developers have historically concentrated on construction and operation of congregate and assisted living properties, leaving the continuing care communities to the nonprofit sponsors. In recent years, however, proprietary interests have entered the CCRC arena in large numbers, mainly because of the evolution of the market. Seniors have become more educated about their options. The communities that provide the widest choice of living units and services are becoming increasingly attractive. There will always be a market for congregate projects, that's the independent. However, many seniors see congregate living as an acceptable, flexible, and cost-effective alternative to nursing home placement, and most importantly, may not feel comfortable about investing hard-earned capital in a senior living project. Nonprofit tax exempt. A nonprofit organization exists by charter issued by the Secretary of State of the incorporating state and must function within the definition of the charter. Most nonprofit retirement communities have been designed by the model of a continuing care retirement community. The CCRC. The typical nonprofit CCRC is not owned by stockholders or private corporation, but rather by its members. Usually the organization is sponsored by a nonprofit affinity group such as a religious order or governed by a board of trustees. In most cases, at least one of the resident members of the community sits on the board as a voting and non-voting participant. The board is usually responsible for setting overall policy and delegates the day-to-day operations to the management. The system works best when the board provides management with the flexibility to run the property, and management in turn demonstrates a willingness to tap into the expertise and business acumen of the various board members. CCRCs by definition operate under considerable competitive and regulatory pressures, as well as internal organizational ones. Newly developed communities are generally required by state regulation to meet pre-sale thresholds before receiving construction approval. The proportion of the advance fees collected that can be used to fund construction of the community varies by state. Most states require the escrowing of resident advance fees during the development period and occasionally even after startup. Generally, pre-sale levels above 75% indicate a reasonably rapid absorption of the community upon the opening. Pre-sale levels below 50% suggest a weak market and are cause for serious concern. Entry fees are usually shielded from federal tax, and some states allow ad valorem tax exemption as well as favorable sales tax and payroll tax treatment. These projects may also have access to borrowing sources such as tax-exempt bonds, which carry attractive rates. The main disadvantage of the nonprofit community is the control is invested in a board of directors who are typically well-intentioned but without financial resources, industry-specific operational expertise, or personal investment. Currently, residents cannot pass through any rollover of capital gains or realize the benefits of any real estate-related deductions. In addition, as the cost of the operation is directly borne by the residents, any increases in debt service are passed along directly to them. By the same token, residents themselves are motivated to control the expansion of services and resulting expenses. Some life care communities have been criticized because their fee calculation has not been based on sound actuarial data. Communities that have relied on the advance payment of entry fees to partially offset operational losses have, upon reaching stabilized occupancy, found themselves without adequate turnover to control operational shortfalls. The turnover generates the entry fees. This risk has been especially acute in communities that have introduced home health care to residents in their apartments in an effort to minimize obligations to provide care in the more expensive skilled nursing facilities. Surplus cash from operations is usually used to fund capital improvements or resident reserve funds, or else it's just reinvested. The accumulation of significant amounts in the reserve can jeopardize the community's 501c3 nonprofit status and render the community liable to taxes. Therefore, management must carefully balance the operation to maintain its nonprofit status while providing for the future cash requirements of debt service, capital improvement, and increased operating expenses as time goes on. The last is especially important for newer communities with substantial nursing home components that, when fully occupied, will significantly increase the operational expenses. Nonprofit taxable. Nonprofit taxable operations typically are designed in the form of cooperatives or condominiums. These operations provide certain tax advantages to their members, such as rollover of capital gains and pass-through of real estate taxes and interest. In addition, real estate taxes and surcharges are reduced owing to the investment in the membership fee that is not producing income. In addition, residents can benefit from the appreciation of their units and retain control of their assets. To many seniors who are used to a lifetime of homeowner ownership, these features are very attractive. The disadvantages include higher financial requirements for entry, substantially more complex residency agreements. In addition, the condominiums and cooperatives usually fall under the auspices of the State Real Estate Commission and exist as a complicated interface of tax laws, real estate laws, and CCRC regulations, some of which are in conflict with each other. A nonprofit operation is generally governed by a board of directors composed of members, the developer, and even some outside interests. The board usually hires a management company to oversee the operations. Usually, a developer structures the program so that its own management company is awarded the management contract. However, most states limit the terms of these contracts to a maximum of 3 years, and surplus cash flow is either used to fund capital improvements or it's reinvested. Operational budgeting. The annual budget process is one of those exercises almost universally dreaded by middle management. It does, however, provide management and ownership the opportunity to evaluate individual operations annually for efficiency, form, and function. Systematic financial planning not only makes financial targets more attainable, but also facilitates accurate cash flow planning and forecasts. Accurate financial forecasts may enable owners to acquire financing at lower rates or distribute greater returns to investors. The goal of the budgeting process is to forecast whether the expenses of running the business, the cash outflows, will exceed revenues collected from the residents and decide how to cover a projected deficit or to conversely how to distribute the projected surplus, the profits. The budgeting process itself can also help reveal areas in the operation where the setting of measurable goals would be especially beneficial to all interested parties. Budgeting revenue. Budgeting revenue is usually based on the projected monthly average revenue per unit. Occupancy projections for the year are multiplied by the average revenue per unit to obtain the total expected unit revenue for each month of the budget period, and then they generally annualize it, which means they multiply it by 12. Average revenue per unit is calculated based on the prior period actual results and then adjusted for expected increase in rent or in increases in monthly service fees. These figures are calculated for each different type of unit by isolating the revenue for each type of unit and dividing by the total number of units that were occupied for the previous full month. Budgeting unit revenue. The number of units budgeted at the average revenue per unit assumes that those units are going to be occupied and producing revenue for each and every day of the month. So this doesn't account for any proration for partial months where someone moved in mid-month or moved out mid-month. Projections for rent or monthly service fee increases should be made for the month in which they're expected to occur. Remember to account for legal notice requirements to the residents as may be applicable or required under local landlord-tenant regulation. Rent increases. Some operators raise rent for all residents once per year at the same time rather than at the anniversary date of the residency agreement. This method can be used only if the fee increases are universally applied across all unit types. Under this scenario, management always runs the risk of an organized protest by the residents, especially in for-profit operations. If management has not adequately prepared the residents to expect fee increases, it may find itself on the defensive and in a pickle. Conversely, if fees are increased on the anniversary date of the individual residency agreement, different increases can be applied to similar apartments with a much lower risk of any collective action. For example, you may want to put a premium on apartments that are closer to the elevator instead of the end of the hallways, and apartments that are on the first floor or second floor instead of up at the top, or apartments that have a premium view. In addition, when only a few of the residents' renewals become due each month, it's easier to deal with individual concerns privately. Effective interest rates on residents. The interest rate factors will play an important role in determining the relative cash effects on the resident's investment returns and the project's debt service. For example, for a resident to qualify financially to live in an independent living community Most operators require that the monthly service fee be no more than 70% of the resident's cash flow disposable income. Assisted living providers typically require 85% because they're more expensive. Therefore, in order for a resident to afford a monthly service fee of $3,100 a month or $37,200 a year, he's going to need $53,143 in annual income from investments in Social Security. That's $37,200 divided by 0.7. Assuming a 7% annual return on his investments, the residents will require approximately $514,285 in assets to be able to produce that kind of income, not including Social Security payments or asset reduction. So for every 1% increase or decrease in interest rates, we'll have an effect of $7,500 on the income produced from the assets, or $632 a month, not including compounding. So little creeps in interest rates can have a big effect on a resident's affordability and their tendency to dip into their reserves, which are the assets. And that's kind of a vicious cycle, because the more they dip into their assets, the less assets they have to produce income to service their monthly service fee. So let's look at the effect now of interest rates from an ownership perspective. For a 250 unit community valued at $20 million with a 75% loan to value ratio and financed with $15 million on a floating rate note, the same 1% increase in interest rates will cost the owner about $150,000 more in interest expense per year. So since the residents are going to have to pay for this, divide this among 250 residents, and your $50 a month increase is required just to cover the increase in the interest expense, and that amounts to about 2.4%, not including normal increases in the operating expenses. So you have to raise the residents' rent 2.4% just to cover the 1% increase in the interest rate. Clearly, in this example, the residents' ability to absorb the community's increase in debt service and operational expenses in an expanding economy will be adequate. So when the economy expands, they should be able to cover that, since their own investments are going up. But as the interest rates decrease, the residents' earnings can fall dramatically, and the community may need to consider refinancing as a vehicle for underwriting the ever-increasing cost of operations. So even though their interest expense goes down, the ability of the residents to cover any increases in operational expenses are dramatically limited, because the residents' income assets aren't producing as much income. So their ability to absorb these increases will be significantly limited. Budgeting expenses. The development of an annual budget is generally a process of evaluation of each expense account on the general ledger against the community's historical results, typically a trailing 12-month results history. And then they consider industry standards and assumptions outlined in the original financial pro forma and projections that were used to develop the project and apply for the original loan. For new communities, the first budget is generally built from these projections in a combination with the industry standards because there's an absence of historical data. Each year thereafter, as the community matures, the actual operating results come in, and that helps you to refine the budget's accuracy. For mature projects, historical data is generally collected based on the performance of the projects over the past years, and then annualized and compared to financial projections and the ownership's objectives. Zero-based budgeting. Zero-based budgets are built without the use of historical data, and they build them from scratch. Typically, it's during the startup phase of an operation. But, some companies build their budgets every year using this zero-based method, arguing that calculating the cost of delivering services based on prior period results compounds any existing intrinsic inefficiencies in the system. So reviewing each department's budget line item from scratch each year can be a more involved process, yet it may uncover areas that can be trimmed. After all, the costs of operating the community are ultimately borne by the residents, some of which may not be well equipped to manage continual annual increases. Also, efficiencies tend to creep into operations over time and build unnecessary costs. So you should really look at what you would budget to start any particular department or operation from scratch, and then compare that to your historical data and see what the differences are. Fixed versus variable expenses. In constructing budgets, expenses that do not depend on changes in the community occupancy, fixed costs, should be separated from those that vary according to the occupancy, which are variable costs. There are fixed and variable expenses in each department. For example, fixed expenses for food and beverages include the chef's salary, cooking utensils, kitchen equipment, operations, and utilities. The variable expenses in the kitchen generally increase proportional with the occupancy, include those for food, staffing, and supplies. Tracking departmental monthly expenditures with a declining balance ledger can simplify budgetary compliance. This is simply a ledger sheet or an Excel spreadsheet listing at the top of each expense category along with its corresponding monthly budgeted amount. So as materials or supplies are received in the kitchen, the department head assigns each invoice or packing slip item to the appropriate account and enters it into their ledger. The expense is then subtracted from the monthly total budget to determine the remaining amount in each category. As the month progresses, the department manager will have an accurate picture of the amount of money remaining. As the budgeted amount in each category becomes exhausted, additional orders for supplies can be placed for receipt in the following month. This way, the department head does not have to wait to see the financial statements to determine whether the department expenses are over or under budget. The declining balance ledger is an excellent planning tool that is particularly helpful to new staff, and its use should be standard procedure for all department heads. Now, nonprofit communities, by definition, have the objective of balancing revenues with expenses, plus perhaps a small surplus to cover a reserve fund in any unexpected contingencies. They can generally provide more services to the residents for the same or lower monthly fee than their for-profit counterparts. This is partially because the profit considerations are not taken into account during budgeting, but also because of their tax-exempt status shelters them from real estate and sales taxes. Capital budgeting. Fixed asset capitalization, also known as capital improvement, is a process of addressing the current and projected physical needs of a property, establishing the costs of maintaining or modernizing it, and creating a strategic plan for addressing those needs within financial constraints. Some financing vehicles require the maintenance of minimum replacement reserves. The adequacy of these fund levels should be reevaluated over time to identify optimal reserve through an iterative process. Clearly, understanding current and future physical needs can help managers control their cash flow, take favorable advantage of credit opportunities, and also avoid refinancing in unfavorable markets. Owners, managers, and maintenance staff should engage in this process together. Capital planning is a valuable diagnostic tool for projecting and managing the community's current and long-term physical, financial, and human requirements. So in the capital planning process, we need to figure out what it is we're really dealing with. So it's important to establish a comprehensive inventory of the community's physical systems, both mechanical and aesthetic. The inventory should also quantify things as specifically as possible. For example, the make, model, size of the mechanical equipment, square feet of paving, roof, common area carpets, and counts by type and size of windows and furniture. All this should be noted as precisely as possible for easy reference later when bidding and budgeting for repairs and replacements. Much of this information can be obtained from your architect. And then you need to determine the life of the estimated life for each item in the completed inventory can be derived from the manufacturer, the warranty, actual experience of the subject site or other like site, industry standards, first-hand estimates made by community maintenance staff, and even outside contractors. With any budgeting process, the capital improvement process, the fixed asset capitalization process, needs to really establish priorities. Number one priority, of course, is health and safety, and any particular capital need that impacts the health and safety of your residents is obviously top priority. The second priority could be assigned to projects that facilitate a more efficient operation, thereby reducing the cost of your operations. Third priority could be assigned to projects designed to meet company standards. Fourth priority could be reserved for major renovations, and the fifth could be assigned to elective projects that may simply promote community enhancement or make your manager or residents happy. So those are your wish list items. Finally, payback periods can be calculated on all items, including installation, that are intended to save operating money. The payback period is the time it takes for the cumulative operational savings to exceed the initial costs. So you calculate it by dividing the initial cost by the annual operating savings. I use the same priority system for establishing my workload for the maintenance director on his maintenance service requests by department heads. So, typically things that are requested by the state need to be complied with as a top priority, as well as health and safety. And for our maintenance, second priority, generally it has to do with the appearance of the building and how the building looks, and it affects its marketability. And third is it would facilitate a more efficient operation, and then the fourth would be figuring out what the payback situation would be. The next thing we're going to do is move into a very brief accounting overview. It's really designed to familiarize managers with some basic accounting principles and their application to operational management in senior living communities. Whether the community objective is to achieve a profit from the operations or to merely balance revenue as expenses, it's important to understand the accounting of the community finances. Several governing bodies in the accounting profession are dedicated to defining generally accepted accounting principles, that's GAAP, by setting up accounting standards and rules. These groups publish formal statements and pronouncements on how to handle all kinds of accounting issues, and their publications serve as an authoritative sources on GAAP basis accounting. Here I only account for the most current provided by the following tests: the Financial Accounting Standards Board, FASB, Statements of Financial Accounting Standards, the FASB Interpretations, the American Institute of Certified Public Accountants, AICPA, Accounting Research Bulletins, and also the Opinions of Accounting Principles Board, APB. There are two primary methods of recognizing revenue and expenses: the cash basis and the accrual basis. It's important to understand both of these methods and the differences between them. The accrual basis, or method of counting, recognizes revenues in the periods that they're earned, that is, when a good has been sold or a service has been rendered, and recognizes expenses in the period that they are incurred, that is, when a legal liability exists. This means that when transactions are recorded as earnings and expenses happen, regardless of whether any cash has changed hands at the time. The cash basis of accounting, in contrast, accounts only for cash receipts and cash expenditures, not revenues and expenses. Thus, transactions are recorded only when there is a flow of cash into or out of the business. For example, when a guest is served a $12 meal in the dining room and the business has earned $12 for that meal. The resident who hosted the guest will pay for the meal next month. Under the accrual method of counting, the business records or accrues the cost of the meal for this month as a revenue and a balance due account receivable from the resident. In contrast, under the cash method of accounting, the business does not recognize the amount due for the meal until the following month when the resident actually pays for it. The senior housing industry lends itself well to the accrual basis of accounting, as residents are usually charged and pay for their services on a monthly basis. The expenses of delivering these services are also budgeted monthly and yield a clear picture of the financial balance of the operation. Next, we're going to cover financial definitions. The general ledger is the final accounting record of the financial condition and results of the operations of the business. All financial business activity is categorized in account codes and recorded in the general ledger. The general ledger then keeps track of all account balances as well as the transactions coded to each account. There are two major types of general ledger accounts. Balance sheet accounts, which keep track of the company's financial condition in the categories of assets, liabilities, and equity, and then income statement accounts, which keep track of the company's operating results in categories of revenue and expenses. Financial definitions continued. Assets are items of value or use that a company owns at any given point in time, which usually help the company produce earnings. Examples of assets are cash, accounts receivable from the residents, the building, the facility van, the kitchen equipment, the furniture, fixtures. Liabilities, on the other hand, are legal obligations of a company that it has to others at a given point in time. Examples of liability are accounts payable to vendors, loans from the bank or another company, payroll payable to the employees, and prepaid rent received from the residents. Equity, then, is the net worth of the company or the business. By definition, it is the net of assets minus liabilities. Financial definitions continued. Depreciation is just the allocation of cost over the useful life of an asset to determine the true cost of operations. Depreciation recognizes the deterioration or depletion in value of an asset over a given period of time or a life of the asset. For example, a roof can be depreciated because it has a certain life. A building can be depreciated. Furniture can be depreciated. Typically, the depreciation of furniture and fixtures and equipment inside an operation is about 5 years, whereas the building may be depreciated over 30. Amortization is the deduction of capital expenses over a specific period of time, usually over the asset's life. More specifically, this method measures the consumption of the value of intangible assets such as marketing and startup costs, while amortization and depreciation are often used interchangeably. Technically, it's an incorrect practice because amortization refers to intangible assets such as the marketing and startup costs, and depreciation refers to tangible assets, assets you can touch like furniture, fixtures, and equipment. Expense it or capitalize it. The costs of operating a business can be either expensed or capitalized. All expenditures for new assets and permanent improvements can be capitalized if they increase the value of the property and clearly have a benefit that extends 3 or more years and generally have a minimum purchase of $200 per invoice with a unit cost of at least $50 and do not fall within the classification of repair and maintenance. Normal repair costs, such as fixing a broken copy machine or a door, those are current expenses and are usually deducted in the year that they're incurred. On the other hand, the tax code says that the cost of making improvements to a business asset can be capitalized if the enhancement adds to the asset value or appreciably lengthens the time you can use it or adapts it to a different use. What you need to know about this is that expenditures that are capitalized will not be expensed and therefore will not appear on your statement of profit and loss. So anything you can capitalize, you should. The expenses, rather, they become a balance sheet asset and are subject to depreciation. Expenditures made for the purpose of keeping the property in ordinary, efficient operating condition, which do not add value or appreciably extend the useful life of the assets, these are repair and maintenance expenses, and they will appear on your financial statement. The facts and circumstances surrounding the expenditure often determine whether it's a capital in nature or an ordinary expense. Expenditures that can be capitalized should be. Expenditures such as these are generally not planned for, in your operations budget, but are dealt with separately in a fixed asset capitalization budget. Financial analysis. Let's start with cash flow. Cash flow is simply the actual inflow and outflow of cash. It is the heartbeat of any business. It's determined by first subtracting any operating expenses from your gross revenues to calculate the gross operating profit or loss. From gross operating profit, then you subtract depreciation, amortization, taxes, and insurance, and then your debt service to calculate net operating income, and this is also referred to as pre-tax income, the actual income that you'll end up paying taxes on. Finally, non-cash expenses such as depreciation and amortization are added back, and then out-of-pocket expenses such as principal reduction, if there is any, and capital expenditures are subtracted to yield cash flow. Let's visualize cash flow. First, you start with your gross operating income. These are all your receipts that you receive from the residents, additional ancillary income that comes in, and then you subtract off any deductions or adjustments to that income, such as rental allowances or credits. And so then that equals your total income or revenue. And then from that, you subtract off all of your departmental expenses, all of your payroll, your overtime, your staffing, all of your benefits, and then the cost of operating each of your departments, your housekeeping, your food service, etc. And that equals your gross operating profit or loss, and that's also known as EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is a number that's thrown out a lot by financial analysts because they use that to divide by a capitalization rate in order to determine what the value is of the property, and I'll show you how to do that in a few slides ahead. So then from your gross operating profit or loss, or your EBITDA, you subtract off your depreciation and amortization, you subtract off your interest expense, you subtract off any other property expenses, taxes and insurance that are applied, and then that equals your net operating income, also known as your pre-tax income. So that's the income you actually will be paying taxes to the government on. So then after that, you add back in your depreciation and amortization because they're non-cash. But then you have to subtract off your capital improvements, which are cash, and you also have to subtract off your principal reduction, which is cash. And so what you end up with then is cash flow. Capitalization rates. Capitalization rate is an indicator commonly used to determine asset value based on a single year's cash flow before interest, depreciation, amortization, and taxes, but after a management fee. So this is the EBITDA that I referred to in the prior slide. Earnings before interest, taxes, depreciation, and amortization. Normally, the higher the capitalization rate, the greater the investment risk. Buyers who have a declining appetite for risks are requiring a higher initial cash-on-cash returns to attract capital because of limited prospects for future earnings and increased property values. Generally, the higher level of care, the greater the degree of management intensity, the higher the risk, and the higher the capitalization rate. So skilled nursing facilities may have a capitalization rate of 14 to 16%, whereas assisted living may be 10% and independent living could be down as low as 8%. Capitalization rates are integrally composed of a number of key factors such as loan-to-value ratio, prevailing lending rate, ratio of equity to value, and equity return. There are very few people who are throwing these capitalization rates or cap rates around that actually even know how to calculate them. And in the next slide, I'm going to walk you through a very easy, simple formula that will help you to calculate your own capitalization rates and give you great advantage over those who just throw these numbers around and have no idea how they're derived. Calculating capitalization rates, or cap rates. As I said in the previous slide, capitalization rates are integrally composed of a number of key factors. These are loan to value, prevailing lending rate, ratio of equity to value, and equity return. All these things need to be balanced in order to get the appropriate return on your investment. I've put together a simple example here using a loan to value ratio of 70% and a lending rate, I'm assuming 8.75% to make the math come out. But if your lending rate is 6.5, put 6.5 in there. And that gives you a 6% number based on your lending rate and your loan to value. And then your other 30% is your equity to value. So if 70% loan to value, 70% is your loan and 30% is your equity. You multiply that by the return that you're looking on your equity, and in most cases people are looking for a 20% equity return. So 30% times 20% is 6%. So you add those two together, your lending rate and your equity rate, and you end up with a 12.01% or 12% cap rate. So let's use this in an example. Let's assume your cash flow before debt service, amortization, depreciation, and taxes, or your EBITDA, is $3,800,000. So let's figure out what your value of the community would be. So at 12% cap rate that we calculated up above, you take $3,800,000 and you divide by 12%, or divide by 0.12. And that equals 31,666,666. So that's how much your project is actually worth if you were to sell it based on a 12% cap rate using those ratios above. People also talk about the multiplier. So an inverse multiplier of the cap rate is a very simple thing. It yields the same conclusion. Just take 1 divided by 12. And so your inverse multiplier then is 8. So it's 8 times your EBITDA, and that comes out to 31,654 and change. So basically the same thing. So some people use cap rates, some people use inverse multipliers. So it's very simple. Using capitalization rates. Well, let's see how you can use these if you're not looking to sell your building. Capitalization rates can be used by management to estimate the effects of revenue and expenses on the value of the community. So even a modest combination of $50 per unit per month in increased revenue or decreased expenses yields $10,000 per month or $120,000 per year. So for a 200 unit project, that's 200 times 50 times 12, that's $120,000. The enhanced value of your community is more than 1 million using an 11% capitalization rate. So you take $120,000 and divide that by 11%, that comes out to 1,090,909. So if you were to increase your revenue per month by $50 or decrease your expenses per month by just $50 per unit, you're adding $1,000,000 worth of value to your community. So as a general rule, every $1 savings in expenses or increase in revenue yields $10 in increased value to the community using a 10% capitalization rate. So it's just $1 divided by 10% equals $10. So if it's $1,000 divided by 10%, that's $10,000 in increased value. So in other words, expense management by department heads has a tenfold effect on increasing the value of the community to the owner or shareholders. Conversely, managers who carelessly overspend their budget will decrease the value of the community for the owner in the same proportion. So what you don't want to have happen is to have your occupancy really low, and so have a very low revenue and very high expenses. So the combination can actually reduce the overall value of your community. And that's where you get people saying that the community isn't worth, the cap value of the community isn't even worth its debt service. So if the combination of your revenue and expense yields a very low capitalized value, then the community itself may not even be worth the loan amount that you have on it, which is a disaster for the shareholders and the owners who equity invested in the project. So not only are they not going to see any return on that equity, they may have to contribute money just to liquidate it. Break-even points. The first break-even point will be reached in a new community when revenues basically cover operating expenses. Industry average will range anywhere from 49 to 67%. Property taxes, location, and type of community will also affect this margin. The second and more important break-even point is reached when the operating revenues equal the operating expenses plus the debt service. At this point is generally lower for congregate communities, then increases with the level of care provided. This factor will vary according to the relationship of debt service to the number of units and the revenue generated from the unit mix. So for a 100-unit assisted living community, this break-even point with debt service should be reached at approximately 80% occupancy. Projects with higher break-even points either are operated inefficiently or carry too much debt. Projects that are overburdened with debt may, for example, be highly leveraged or very expensively built. As a general rule, it is important that a community operating at stabilized occupancy have a capitalized value equal to or greater than its debt service value. So projects that fall short of this target are probably not worth their debt service balances and will cost equity to liquidate. Gross revenue multiplier. The gross revenue multiplier is derived simply by dividing the sale price by the annual gross revenue. It is perceived to be more reliable because gross revenues are easier to calculate than net operating income, especially consider the wide variety of operational models employed by different owners and managers in the industry. So in the preceding example, let's say the sale price was $32 million and the gross revenue was $7,800,000. The gross revenue multiplier would be 4.1. The higher the multiplier, generally the more efficient the operation, and the higher the revenue trends. Conversely, a low multiplier may be an indication of an inability of residents to absorb increases in operational expenses. Now we're going to shift gears for a little bit and we're going to talk about different financial ratios that you should be familiar with. The first and most important, of course, is the debt service coverage ratio. So you start with your excess or deficit of revenue over expenses. You add your interest expense, you add your depreciation expense, you add your amortization expense, and then you subtract any amortization of deferred revenue from non-refundable advance fees, if there are any. Usually there are not. Generally those apply in continuing care retirement communities. And then you add the proceeds from any advance fees or deposits, if there are any. And then you subtract off refunds of advance fees and deposits, if there are any. And that equals your net available. So your debt service coverage ratio is equal to your net available divided by your maximum annual debt service in dollars. Let's explain this further. The debt service coverage ratio measures the ability to service debt from two sources: the debt service coverage ratio operating and non-operating income activities, and cash flows from receipt of advance fees, deposits, less any refunds. So the debt service coverage ratio is more easily understood if it's dissected. The denominator, which is your maximum annual debt service, which is interest and principal, that's straightforward. However, the numerator is known by several names, including net available for debt service, net revenues available for debt service, or simply just net available. The calculation of net available adds in actual cash from advance fees, if any, net of refunds, and subtracts non-cash revenue associated with amortization of any advance fees. Thus, the amortization portion is correctly excluded from the net available because it involves no cash flow. By using this method to calculate coverage, the ratio accurately measures the community's ability to service its debt. So a debt service coverage ratio of 1.25 means that for every $1 in debt service, the project produces $1.25 in cash flow. The next financial ratio we're going to cover is operating margin, which is widely considered a measure of efficiency of your operations. The operating margin reflects that portion of the total revenues retained as operating income, and as it relates only solely to the operations. This ratio is also referred to as operating profit margin. For example, a 250 unit community fully occupied with $7,800,000 in gross revenues and $4 million in net operating expenses will have a net operating income of $3,800,000. So that's simply $7,800,000 minus $4 million. The operating margin is then the ratio of $3,800,000 to the original $7,800,000 in revenue. So it's your net income related back to your gross revenue. And in this case, you divide one by the other and you come out to 48%. The operating margin can also be calculated by subtracting the expense ratio from 1. So 1 minus 0.513 equals 0.487. In the assisted living business, in my experience, operating margins that are less than 50% generally indicate a fairly efficiently run operation. So that's really what you should be targeting. In our example, 48% falls well within an efficient operation. Financial ratios continued. So the operating ratio or even the expense ratio is very useful. By subtracting out non-cash items such as amortization of debt issuance expense, the operating ratio determines if ongoing cash revenues sufficiently cover outgoing cash expenses. So the ratio also measures the adequacy of periodic service or monthly fees. The operating expense ratios are a useful tool to determine overall operational efficiency. They're an expression of the proportion of operating expenses to gross revenue. Operating expenses should include management fees, but should be net of any depreciation, real estate taxes, capital improvements, and debt service. Let's look at an example here so that it doesn't seem so confusing of these operating and expense ratios. A 250 unit community fully occupied with $7,800,000 in gross revenue and $400,000 thousand in net operating expenses, we'll have an operating expense of 4 million divided by 7,800,000, or 51.3%. To approximate net operating income from an expense ratio and gross operating income, you just take the gross operating income times 1 minus the expense ratio. So in our example, 7,000,008 times 1 minus 0.513 equals 3,798,600. So that's going to be an approximation of your net operating income. So this compares pretty closely to our 3,000,008 that we calculated in our operating margin example a couple of slides ago. These expense ratios will vary with the size of the community, underlying the importance of the economies of scale. In for-profit communities of under 200 units, an expense ratio of 70% may indicate a well-run operation. However, as the number of units increases to 250, an expense ratio of 60% may be more in line, and if there are more than 300 units, ratios of 50 to 55% are considered appropriate. Of course, nonprofit communities will have operating ratios close to 100%. So now the trick is to look for ways to cut costs that are transparent to both your employees and to your residents. Remember what we said earlier, that as a general rule, every $1 savings in expenses or increase in revenue yields $10 in increased value to the community using a 10% capitalization rate. And that's $1 divided by 0.1 equals $10. In other words, expense management by department managers has a tenfold effect on enhancing the value of the community to the owner. Conversely, managers who carelessly overspend their budgets will decrease the value of their community for the owner in the same proportion. Smart menu planning for volume purchasing can allow you to save anywhere from 10 to 15% on your food cost by purchasing case lots and things that are on sale and things that are in season, such as vegetables and fruits. Some food vendors have computerized purchasing that enables you to input a maximum budget allowance and then automatically deducts each purchase item from the budget allowance so the manager can see where they are on an ongoing basis. Another thing you can do to manage your cash flow is to stretch your payables. And so instead of paying the bills as they come in, you might be able to hold them for 30 days and or hold them for 60 days. There are certain bills that will not be able to be stretched, such as your mortgage payment and your utilities and your real estate taxes. But most other vendors will allow you to stretch their payable up to 60 days without complaining too much about it. There are federal and state programs for the conversion of inefficient incandescent lighting to efficient fluorescent lighting, and the conversion of the old analog fluorescent ballast to a digital fluorescent ballast. Because these programs are subsidized, many of them can often see a payback period with a lower electric bill within less than a 2-year period. You can also work an arrangement to lease the equipment that you were converting to and pay off the lease payment with your savings from your electric bill, so there's no cash outlay for you to do the conversions at all. So it's a really smart program. Since the single biggest cost expense in your operation is your staffing, a close look and scrutiny of your overtime practices can really yield a lot of quick results and save huge dollars in your operation. In the next slide, we'll explore some cost-saving ideas for reducing your overtime in detail. Cutting costs painlessly. Overtime. First and foremost, department heads need to handle all call-outs. Employees should not be requested to find their own coverage, as they'll work with each other to call out and maximize the amount of overtime each other will get. Managers need to fill all shifts by calling on part-time employees first. And you might also consider licensing your activity staff as nurses' aides, which may be used for coverage in the event of callouts to meet legal responsibilities for your regulations. Also, it's a good idea to hire full-time or part-time people for floaters, or to establish a per diem pool. When you establish a per diem pool, you can advertise for free on Craigslist and bring people in and promise them 1 to 3 shifts per week. And it's a good idea to find at least 3 floaters that are available to cover call-outs and vacations and sick time in each facility that you're running. We also employ a bonus incentive for perfect attendance. We give our employees $100 for each 3-month period that they have perfect attendance, no call-outs, no missed shifts. Also, if we have 3 unexcused call-outs in 6 months, we enforce our policy for termination. So if people are calling out regularly, those people are just going to cause more overtime for you in other areas, and you need to get rid of them. Also, take away any double shifts that result in overtime. As a general rule, I don't allow any people to work a double shift where there's a second person who's always also working a double. And I think sometimes managers will jump at the opportunity to cover their weekend shifts with 2 people working doubles. But if you've got 1 person working a double, that's a 16-hour shift, and it's very difficult for that person. And we can do it from time to time, but when you have the second person who is not fresh, who is also working a 16-hour shift, I think that puts your residents at potential harm. Also, do not use overtime for favoritism. Extra time should be based on who is not in an overtime situation to work the shift, then based on seniority. Not who you like, who needs extra money, or who is the first person who happened to say yes when you asked. Also, it's a good idea to replace staff on disability who have exhausted their allowance under the Family Medical Leave Act. So leaves will be granted for a period of up to 12 weeks in any 12-month period, or longer if required by applicable law. An employee must have completed at least 1 full year of service and have worked a minimum of 1,250 hours in the 12-month period preceding the leave to be eligible. Those are the federal guidelines. Holding positions open indefinitely for people who are in and out of family crisis and in and out of need for family leave results in significant overtime. Since the food service operation is your second largest food cost in the facility, it warrants special analysis. One fundamental decision about meal service is dining room hours. The dining room can be open continuously, open for a specific period of time, which all residents can be served, or open and closed for shorter period times using prearranged seating times. Generally speaking, the longer the dining room is open to the residents, the higher the labor cost of both front and back of the house. The longer the dining hours, however, provide maximum flexibility for the residents and lessen the institutional feel of the community. Residents who are used to eating whenever they wanted before and then moving into a community typically have some difficulty adjusting to predetermined dining times. The problem with open seating times in the dining room is that even though it must be operated like a restaurant, offering flexible seating and preparing meals for residents as they arrive, most people come down to eat at roughly the same time. Restaurants are inefficient in feeding large numbers of people quickly. They count on the fact that their customers will arrive and eat at different times over several hours. If all of their customers were to arrive in a 2-hour period, seating, service, and production capacity would be quickly overwhelmed. When the restaurant reaches its capacity, it simply turns people away or asks them to wait. Of course, this can never happen in a senior living community where residents have already paid for their meals through their monthly service fee. Multiple seatings offer a way to give top quality service within a limited time and with limited staff. This concept can be applied to one-on-one for all meals. The dining room is closed for 30 minutes between the seatings to allow the food service staff to reset the dining room and the cooking staff to prepare the next set of entrees and vegetables. The advantage of two seating arrangements are the following. Operating costs are much lower. Staffing costs are lower because only 1/2 to 2/3 of the population needs to be served at one time. Usually 60% of the population will choose the first seating when offered a choice. The food is plated and served more quickly. The food is fresher. The residents don't have to wait to be seated. And seating, of course, can accommodate different resident profiles. Most communities serve both active and frail residents. Often the two profiles don't mix very well, particularly at meal times. So assigning them to different seatings can alleviate the problem. You will find that the two-seating program will result in increased resident satisfaction. Residents perceive staffing and food quality as improved when they are seated and served in two smaller groups rather than in one larger one. The system maximizes the efficiency of the kitchen while providing the residents with the service and promptness they expect and deserve. In a 200-unit community, you're going to have about $25,000 worth of china, silver, and glassware. And at 25% loss annually, that amounts to over $6,000 per year in just replacement costs. Much of this china, silver, and glassware ends up in the residents' apartments and their cupboards because of tray deliveries that were failed to be retrieved upon completion by the resident. So it's not a bad idea to use disposable products for tray deliveries so you don't have to worry about losing your china, silver, and glassware and also having to schedule a staff person to go and retrieve it. Also, it's really important to train everyone how to properly rack and stack china and glassware properly. There are certain racks that are specifically built for glassware and china, and you can significantly reduce your breakage by properly stacking it in the rack that it's intended for. Another idea to reduce your staffing costs is to use your kitchen utility staff to assist with side work. In other words, to assist with resetting the tables, bussing and resetting the tables between meals. So that's a good idea, and it allows you to use less wait staff per meal than you normally would without it. Also, as any restaurateur knows, portion control is critical. If you overload the plates, then people are embarrassed that they leave food on the plates, and also a lot of food ends up getting wasted. So you should decide exactly how many ounces of fish or how many ounces of any particular meat stock that you're going to use in an entree, and portion out those cuts of meat prior to cooking so that they're easy to plate up and they look nice on the plate, and you're not over loading the plate with too much food product. It's also a good idea to periodically review your menus and see if there's a way you can lower your food costs by selecting certain items. Also using computerized ordering, as I mentioned before, or spend down sheets. And also you should order your food based on your actual census of number of people that you're going to serve, number of people that are actually in the building, rather than your economic census of who may have left mid-month and is still paying till the end of the month. Just to give you an idea of what impact that savings in food costs can have on the bottom line, a 200-unit community serving 3 meals a day for 365 days a year is going to serve 219,000 meals. So if you can drop the food costs by even 50 cents per patient per day, that's going to save you over $100,000 and drop it right to your bottom line. $100,000 at a 10% cap rate is over $1 million in value that you've just increased the property value. Also, lowering of your workers' compensation rates and getting a new experience rating. Now these are rolling 3 years, but by using aggressive claims management and also paying some of the claims out of pocket, the smaller claims out of pocket, so that they don't end up hitting your experience rating. And there are companies who can manage these claims for you. and are very good at lowering your costs. You can save yourself up to $50,000-$60,000 a year just by managing your workers' compensation experience rating. Also, we've been able to save up to $10,000 a year just by controlling our laundry chemical usage. When the nurses' aides are doing the laundry, they typically take a whole cup of laundry detergent and put it into the laundry machines, and the machines really only require a quarter of a cup. And by portioning out the laundry chemicals or installing one of those automated dispensers, they'll quickly pay for themselves, and you can save a lot of money doing that. Also, you might want to consider if you're using credit cards to enable your residents to pay for their bills. These credit card rates are extremely expensive and can really creep up on you. And just have a close look at what that's costing you. In our facilities, we eliminated accepting credit cards and saved $50,000 a year. Finally, reducing your newspaper advertising, which isn't as effective as it used to be since most people seek out their information on the internet, and hiring a community outreach director to increase the referrals can be a much smarter use of your dollar, your marketing dollar, because referrals that are generated are generally much more need driven than people picking out your ad in the newspaper. So these are all cost cutting strategies that are relatively painless. They're more about running a more efficient operation, and all of them are relatively transparent to your resident and your customers. Service contracts. Most large facilities do have service contracts on many of their larger equipment. This equipment, which requires specialized training or tools to maintain, just like your elevators, fire suppression systems, your alarm systems, and anything that affects resident safety. It's important to solicit bids from contractors who are your dealers in the brand name of the equipment, rather than have somebody that does a whole laundry list of different equipments. Find the service contractor that specializes, installs your particular brand equipment, and they're more of an expert on it, and they also are able to secure parts at a discount normally. Also, it's important to renew your contracts every year. Most service contracts come with an evergreen um, feature where they automatically renew. As prices are increased, these contracts should be rebid. Also, keep a ledger on all service contracts with the contractor's contact information, essential elements of the contract, parts included, whether it's included or not, when or when not to call. You don't want to call your service contractor in for something that your maintenance man can take care of. Contractors charge a premium on night and holiday visits, and so clearly define to your staff what an emergency is, and more importantly, what an emergency is not, that can wait until Monday, that doesn't affect the resident's health and safety. Also, collect a written statement from the technician that makes the call so that it can be later compared to the invoice. Keep track of all times that technician was actually on site. Often they will bill you uh, for 3 hours when they were only there for 45 minutes because they need to fill up their work order sheet. Also, any service contract should come with a certificate of insurance so that you are an additional insured at your facility for routine contractor in the event the contractor is injured there. Management incentive plan. The quickest way to get everybody's attention on saving dollars is to incentivize them. Most managers and staff respond extremely well to incentives. So, any compensation plan that you have for them should have several components, both of which reflect your mission and emphasize what your goals are. So, a fixed salary portion can provide income stability, and a variable element in bonus incentives. The fixed component can be their base salary, and the variable can be their bonus. The variable component of the incentive plan enables each manager to earn up perhaps to an additional 20% calculated on their base salary. And it's a good idea to pay these things out quarterly so they can have some immediate gratification for their efforts rather than waiting for the whole year. Also, once people start earning these bonuses, they tend to live up to that level of compensation. So there's incentive on their part to maintain their performance and to continually get these bonuses because most people spend what they make. Also, any plan should provide incentives for achieving performance in the various categories that you're trying to manage in terms of your goals. So it could be expenses, your census. It should also be tied to your state survey results, and of course your family and resident satisfaction and your employee satisfaction. So sometimes these goals are mutually exclusive. So an incentive plan that balances them all out will prohibit somebody from sacrificing one component of the plan to earn another. Here's a sample incentive plan that has been very effective for our managers. So, we consider a base salary as an example of, say, $60,000. So the maximum award, annual award, would be 20% of that, or $12,000 in additional compensation. So what we broke it up into several categories. The EBITDA management, to achieve the target, they can earn 25% of their maximum award. For census, 25% of their maximum award. State survey results, 20% of their maximum award. Family satisfaction through our exit surveys, 15% of the maximum award. And employee satisfaction through an employee survey, 15%. So you add up the 25, 25, 20, 15, and 15, and it's 100%. So on a quarterly basis, if they achieve the goals in each of the categories, for their EBITDA, they can earn 750, for a census, 750, for state survey results, 600, and for the family and employee satisfaction, 450. So each manager can earn an additional $3,000 every quarter if they achieve all of the award targets. So what you're able to achieve with this is an incredible focus on expense management by the people who control all the purse strings, which is your on-site day-to-day managers and department heads. And so it's kind of a partnership between providing them incentive to control the costs while at the same time keeping the quality up. You never want to get into a position where you're compromising your quality to save expenses, because your residents will become immediately aware of that and they'll start questioning the value for the price that they're paying. Complying with financial covenants. Most lenders will require certain financial minimum performance thresholds for the operations of the communities that they finance. These operational thresholds can be occupancy covenants, operating margin minimums, EBITDA minimums, capital improvement reserves that are set aside, operating account reserves or escrow funds that are set aside to fund ongoing operations. They may have regulatory punitive action covenants in the event you get into trouble. They can withhold financing. Failure to meet any of these covenants can trigger a default. Defaults may or may not provide for a cure. Some defaults can be covered by a forbearance agreement, which provides a temporary reduction or suspension of payments for a specific length of time while you get back on your feet. Other defaults can be covered with global amendments to the original loan agreement, which specify revised targets that are necessary in order for the bank to continue their relationship with you. Ultimately, most banks employ a foreclosure step in the event that the defaults remain uncleared. I just want to leave you with one final word on ratios. Ratios are not in and of themselves proofs, but rather clues providing a basis on which to form a judgment. Suspicion of an unfavorable condition might be aroused by an unsatisfactory ratio. Conversely, the conclusion that a community is financially strong may be confirmed by compiling a series of ratios. The significance of a ratio may vary with different forms of ownership. In analyzing a for-profit community, for example, particularly emphasis is laid on the operating or expense ratio. In a nonprofit community, this ratio is somewhat meaningless because you're intended to balance your expenses and your revenue. The drawback of ratio analysis is that even though they may be useful for setting minimum standards, they're heavily dependent on a component that can remain constant over time, such as your debt service, whereas other elements are increasing for inflation. This results in unusually high ratio values in future years. Therefore, taken alone, ratio analysis can present a misleading picture of the community's financial picture. Ratios calculated from a community's financial statements for only 1 year have limited value. They become meaningful, however, when compared to other ratios internally, that is, with a series of similar ratios for the same community or company over a period, or externally with comparable ratios for similar companies or with industry averages. When comparing ratios externally, it's important to ensure that not only the communities are similar, but also that the basis used to calculate each ratio is the same, because they do vary from time to time among companies and between industries.